Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Will Moorcroft, how are you today?
Great. Good to be here as always.
Yeah, good. Listen, we've been working on some interesting projects, and we're having some interesting discussions around suitability and recommendations and what it means to do that in a digital age, right?
Yeah, it's great conversations and love the topic.
Yeah. Mark, great
Good morning,
to see
Paul.
you.
Great to be here.
Yeah. Similar. Like the business just keeps changing, right, on a daily basis.
It certainly does. It's very dynamic, isn't it?
Yeah, and our the next month with our with our annuity program will definitely could perhaps be a topic of another podcast on how the market's changing, right?
Yeah, undoubtedly.
Yeah. Last but not least, Ramsey Smith, welcome.
Hey, I'm always delighted to be here. Favorite part of my
and
week.
Hey, listen, I got to tell you, congratulations.
Thank you.
For those of you who don't know, Ramsey was recently appointed on the board of directors of a publicly traded company, none other than Genworth Financial, and that's just wow.
Thank you.
What an endorsement, and Ramsey, I think you're going to bring some just terrific insight to that board and how they how they approach sort of the next 5-10 years of business, right? Fascinating market.
It's an amazing market. I've spent many years focused on the insurance industry. Certainly the work I'm doing right now is focused on what I think the future of the industry should look like. And so what's really exciting about the opportunity to serve on that board is it really ties together all the things I did over a 20-year career at Goldman, along with a lot of the things that I've been working on in my current venture, Alex FYI, and I'm just delighted to work with the team, so very excited about it.
Yeah, and got a great guest. Do you want to do the honors of introducing Ethan?
Absolutely. So we're joined today by Ethan Schwartz, and Ethan is a law school classmate of my wife's, and he has been a very active voice as a consumer advocate, predominantly via his Bloomberg Businessweek columns. And I think his starting those columns was more or less contemporaneous with a lot of the work that we've been doing at Alex.fyi. And so we've had very interesting sort of discussions online and offline over that time, debating various things. But I think what's been most striking is that at the end of the day, we care about the same things. We care about consumers. We care about the industry, and Ethan comes with really just an amazing background. He spent many years working in the Clinton administration, and he worked as a portfolio manager. And we're just really lucky to have him here today because he brings us great perspective on institutional quality skills. And he's taking all that and he's really lending that to his discussion of how to help consumers. So with that, Ethan, I hand it over to you. Tell us a little bit about your journey.
My journey, well, it's basically as you described it. I went to law school, joined the Clinton administration and the Treasury Department. Mainly started working on international affairs, but then some domestic issues. moved over to Wall Street, where I spent north of 20 years. Full disclosure, my professional career on Wall Street had very little to do with any retail investment or financial products. I was an institutional portfolio manager and analyst. I worked on high yield credit. I worked on distressed debt, special situations investing. I spent more than half a decade at a hedge fund, and then about a half a decade at a large institutional investment manager in their alternatives investment group. So my interests in consumer financial issues are really something that just, my interest was piqued by the things that I saw throughout my career, and I'm very much learning and analyzing as I go. So that's my background.
Got it. So, what are some of the main things you want to see in the business going forward? I've seen you write articles about everything from fiduciary responsibility to pricing to transparency. Help us sort of get a sense for what are the things that you want to see the industry do, and later would love to get to some of the things you think the industry is doing right and should grow in. Sure.
Look, my philosophy is pretty simple, and I think that's the point. I just want to see simplicity. I think the great thing about finance and financial markets nowadays is that for the average person, things can be so simple, right? 30, 40 years ago, mutual funds were in their infancy, index funds were in their infancy. You couldn't go online and just sort of in 2 minutes open a Vanguard account and put your money in an index fund. You couldn't get financial information. Now it's so simple. And I think that a lot of the products that are out there, a lot of the regulatory structures that encourage people to invest in a certain way and even force people to save in a certain way, give tax incentives for people to serve in a certain way. They were fine 40, 50 years ago when people didn't have access on their own. Now they do. And I think products should move in that direction. I think they are moving in that direction. I think the laws and regulations should move in that direction. I also think financial advisors should move in that direction. I think financial advisors can now give very simple, easy advice that, they can follow up on or that people can follow up on. So that's sort of my general philosophy. I don't know if that's clear or not.
Sure. And
Ethan,
go ahead.
I was going to say, Ethan, can you talk more about kind of the tax incentives? I know you wrote an article around 401k plans and some of your thoughts in terms of the guidance behind that and the direction that you feel it could be going. Can you expand a little bit on that?
Sure. I mean, it's 401k is an good example, but I think the general preference that are given to insurance-linked investment products is probably, which I'm still learning about, is still is sort of the big issue. So if you look at 401ks, I mean, I'm not sure why the encouragements that are given to people to save money require that they be channeled through employer-based 401k plans. I understand why 40 years ago people maybe just didn't have the information or couldn't be relied on to pick safe and easy to understand investment products. And so they kind of had to rely on their employer to do it. And employers had to rely on fancy plan sponsors and so forth. Nowadays, again, it's so simple. I mean, look at the I may be misusing the terminology because this isn't my specialty, but the federal savings plans where federal employees have such an easy choice of just investing in basic index funds, and I think it costs them like 0.03% a year in management fees. Same thing with 529 plans in various states. So there's no reason why the same that I can see. I could be wrong. There's no reason why the same types of choices with the same low expenses couldn't be offered to everyday people who aren't working for the federal government, No need to have the employer take on the burden of being responsible for managing those plans. They could be structured with the same incentives, contribution matching, tax deductions, tax deferral, all the same things. Just let people choose very simple products that are cheap. Probably make them more money.
Yeah, Ethan, if love the idea. What kind of coalition would you have to build to make something like that actually happen?
None is the answer, and I think that's a big part of the problem. I think, look, this is an example of you have an investment management industry that has only one goal in life, and that's to preserve itself in its current form. And you have it's, all kinds of things are like this. The medical profession is like this, healthcare is like this, liquor distribution is like this, right? In every state, liquor distribution is protected. When a bunch of people, when their industry depends on a certain regulatory structure, they fight tooth and nail to defend it. And average people, for whom this is about 1/1000th of their concern, they got bigger fish to fry. They got to get their kids to school and pay the mortgage and go to work. There's no coalition. I think I'll tell you when I think you get a coalition. I think for certain high profile issues, like mortgage steering, real abuses, real financial abuses, payday lending, things like that. When people recognize something that's horribly wrong, then you get a coalition to change things. But for sort of everyday things that could just be a lot better, I think it's hard to get a coalition.
So, this is as I've listened to you over the years, Ethan. This is and I listen to you now. I mean, I hear some of the same sort of journey that I took mentally, because if you're somebody that does what you did or I did institutionally, like everything we did was very much about pricing and transaction costs, and so there are things that that maybe we will just sort of see and gravitate to that aren't necessarily as obvious to the rest of the world. All right, so that's the first thing. But the second thing that is interesting to me, and I think Paul's question about a coalition is a very interesting one, is that it's not my view has evolved to this idea that it's not enough to just tell people you can do this for less. Right? It's not enough to hand them a random walk down Wall Street and say, please read this, because I've done that many, many times, right? And the answer to that is like, hey, buy index funds. But that same person will come back to you and say, okay, I bought an index fund, now what else do I do? I think that there's this behavioral element that's in there that people want variety in the way they invest. I would argue that a lot of people want excitement in the way they invest, and that's
look at GameStop. I hope that's been exciting for a lot of people.
Go ahead.
No, I think you're right, and I I'm not by nature a big government interventionalist. In many ways, I'm anti-regulation. And look, maybe we only need one regulation. Maybe we only need one fiduciary duty rule that says, if you're going to give financial advice, you better give the best advice, and make it, it could be a one-line rule and not have all kinds of safe harbors and procedures and suitability rules. Just darn it, give the best advice. And so if somebody goes to a financial advisor and says, hey, I'm 40 years old, I got to save money until I'm 65, and then I need to be able to pay this much for my retirement, what's the best thing I can do? Yeah, I think financial advisors should be allowed to charge for that advice and, offer the best products and say this is how much monitoring you'll need over the years. And, that's cool. But what I don't think is that you should have a regulatory system that allows or that encourages investment management companies, insurance companies to design these incredibly complicated products that, 99 times out of 100 give lesser results, that are far more expensive, that have credit risks and legal, what I would call contractual loopholes in them. That's, I kind of think, it's not all the time. Maybe it's not even 50% of the time, but I think it's a sizable percentage of the time is what's happening now. And I think it's sustained by the regulatory system.
Well, I guess
You want, I can give you, maybe we should go to specifics, because like that would be a more, easy thing to understand. I don't know if you, because I got some juicy ones, so we can, we can
I
talk
think
about that.
a big challenge for consumers in the market today is the difference in terms of structuring an investment process from an accumulation standpoint versus an income and distribution standpoint.
Right, absolutely.
And the big challenge, I think, for investors today is really kind of how do you factor in that longevity risk? And I think that's where insurance companies have really, taken hold in terms of an opportunity to prevent a client from outliving their income. And
Well,
I guess
yes,
thoughts
and
behind that.
okay. I mean, like again, full disclosure, I've never been in the insurance industry, and my background consists of homemade analysis that I've done with financial statistics from the St. Louis Federal Reserve and, Bob Schiller's website up at Yale. But every time I won't say every time, but a lot of times when I examine a longevity product or some kind of annuity whose basic goal is to protect people from outliving their money, I got to tell you, it's pretty expensive. I mean, let me give you a concrete example, right? So a major insurance company introduced a product especially for 401ks in response to the Secure Act that passed recently, which makes those easier to put into 401ks. And this thing promises to give you, I forget the exact statistics. Basically, if you retire at 65, you get like 5% a year of your money, and if the pot goes up when you get to 71, you get 6% of your money. And it seems like a great thing, right? Because if you live to 105, and the money never goes down, right? Even if the pot goes down in the real world, in the market world, they will keep you level at that initial payment, right? So that sounds great. All right. So I was noodling on this. So here are some really interesting things about it, just to give you a typical example of how these things are structured. So first of all, you got to start moving your money into this thing 10 years before you retire, right? And because the so-called balanced fund or balanced set of investments that they put you into has a 1.7% annual fee attached to it, and which is huge, right? And that starts at age 55 when you start moving your money in. And then because their balanced funds have underperformed index funds by about 2% a year historically, by the time you get to 65, the amount of money in your pot is already a lot less than it would have been had you just spent those 10 years putting your money in sort of identical balanced funds, right? So right from the get-go, the 5% that they're giving you a year is really more like 4.3%. So that's like problem number one. Problem number two, if you go back historically and you just do analyses of balanced investing, right? Rebalanced once a year, which is, now if you couldn't do it for your own, there are cheap index funds that will do it for you, right? Basically, that number, 4.3%, is what you could safely withdraw for 40 years on your own, even in the worst of times, right? Even if you invested on the eve of the Great Depression, you would have been able to pull that money out, right? So they're not really giving you anything that a financial advisor couldn't give you on your, and you should pay a financial advisor for that, right? You should pay a financial advisor $500 for the initial consultation, whatever the going rate is, and then if you can't figure out on a calculator how to pull out that amount of money every year, pay somebody to do it. But they're charging you 1.7% a year going forward in underperforming funds throughout your retirement. And they can legally raise it to 2.7% under the terms of their contract. So that's a huge cost for something that historically could be done far more cheaply through index funds. But wait, it gets worse. It gets much worse. The way their contract is structured, they stop popping you up at age 86. And that's tied to the other huge flaw in this contract. While it's very seductive to say that, gee, if the market goes up, we'll raise your 5% or your 6%, whatever it is, to the percentage of the new pot, there's no inflation link, okay? Zero inflation link. That's disastrous. Why? Because first of all, precisely when you need the longevity protection, right? At age 86, when now you're in the group of people who, gee, you might really make it to 100, right? And you're pulling out 5%, which could be based on the pre-inflation dollars of where you were 20 years earlier, right? So you already might be in the hole. But even if you're not, even if that pot has been growing with inflation to age 86, now you're frozen, all right? So now at age 86, you're frozen withdrawing that, whatever the level has reached, 5% a year of where your pot has grown. And inflation keeps going, right? So now precisely when you're in the real longevity period of your life, the period where you got to keep track with inflation, they've frozen you. You can really get hurt, right? There are a lot of other, so this is a typical example to me of something that looks really reasonable, enticing on the surface. But when you look at the expense, you look at the way the expense continues, excuse me, from before you retire, it continues through the whole period. The contract has this gotcha where it freezes you at age 86. The expense is so great that it almost ensures that at some point the pot ceases to grow. So you're not going to get the benefit of that growing pot. And none of it is linked to inflation, which is what you really care about, right? You don't really just care about dragging 4% out in, over 20 years. That's worth half of what it originally was if there's no inflation. You care about inflation. And all the worst performing portfolios have been poorly, throughout American history, have been poorly performing because of inflation. When you look at all of that, this is a pretty questionable product. And that's a good example.
So Paul, do you want to go first, or
yeah?
Either one.
Let me take the first poke at that, Ethan. Obviously, listen, we're fans of annuities and the basic protection that they provide. I think I would like to talk to you about how we reduce the costs, right? Using fintech, using different, because I think there's some. I'd like to sort of talk about the masses, right? Because most people. It would be great if everybody could afford, to pay a financial advisor by the hourly rate. The reality is that's a very elite group of people in the country who can. So I think there's an interesting challenge of how do we bring this, retirement security to the masses. I think that's kind of one track to go. Just sticking with your annuity analogy, because we have discussions. I've had discussions, online with people about, well, what's the ROI on the annuity? And I say, well, it's really, an ROA is important if you're looking to accumulate money. However, these products at the end of the day are insurance, not investments. And, Ethan, really what you should look at is the tail risk you're providing. Kind of like saying, well, what's the ROI on your homeowner's insurance? Well, not very good unless your home burned down, right? So, on average, yeah, it's probably, you're not going to get rich. You're not going to accumulate a lot. But if you're, one of those people who does live out much longer, you've taken a ton of tail risk off the table. What's your response to that?
Well, okay, I think there are a couple of things. I think you make an excellent point about ROI. ROI is not necessarily the best or even the only way to look at these products. What I'm saying is that, first of all, there are particular products like this one, which I think are leaving you with much more tail risk, much more downside risk than they seem to on the surface. This one I say is so interesting because if it freezes you at age 86, that's precisely when you want the tail risk protection, right? And yet you're getting frozen, right? So that's precisely the type of product that I think is not really offering you the protection that it seems as if it's offering you. And they're doing that deliberately, I think. Right? So I'm not saying they're evil. I think they probably actuarially have to do it to cover the to pay the rent, but that's it. So that's one thing. The second thing is I'm not saying that again, I'm not saying that ROI is the most important thing. All I'm saying is that we could have a regulatory structure in this country which, if somebody is giving you financial advice, they have to give you the best of financial. I just think they should show you the alternative, right? And Ramsey and I have talked about this. If someone is selling you an annuity, let's take a step back. That means you probably went to them and say, hey, I got to retire in 10 or 15 years. I need to know, how should I save my money over the next 10 or 15 years? How should I accumulate my money? And second of all, what can you do for me that will help me withdraw my money and make sure that if I live to 105, I have enough of it, right? Now, I think it's perfectly reasonable to say, well, we have this one product over here, and here's how it's structured. And make sure you disclose to all the people, well, you're going to get frozen at age 86, and it's not index inflation, and so there's all of those risks. But I think there should also be an obligation if somebody's providing financial advice, whether in an insurance context or a brokerage context or whatever, to say, but wait a minute, let me show you this. Historically, if you do these scenario analysis or historical analyses on U.S. bonds and stock markets, there has never been a time in 120 years that putting your money for 20 years before retirement or 15 years in retirement into a balanced fund and then withdrawing 4 or 4.5% a year indexed for inflation, that you would have run out of money. And those might not be the precise parameters, but you can show people on a graph and you can say, there's a 98% chance you'll make it with the index funds and the withdrawal rate. There's 100% chance you'll make it with the annuity product, although the insurer could go bankrupt, of course. So it's nothing's 100%. But you'll have this much more upside and this much more protection against inflation on this one, and you'll have potentially this much on the insurance product. I just think people should be shown that. And let them make up their minds on their own.
Hey, Ethan, I hear what you're saying, and I tend to agree with you that you should present multiple options to individuals and let them make informed decisions. How do we get there, though? We have kind of a bifurcated financial services market where we have people doing what you're saying, and then we have people that might just be offering a suite of products that are just insurance based. So how do you bridge that gap?
Look, that's a tough question, and it has to do, again, I think with the history of state and federal insurance and securities regulations. Again, I'm hesitant to say there should. I don't think there will ever be a sweeping rewrite of state and federal insurance or investment regulations, because I don't want to sound like some kind of radical, but I do think it's just a fact of life. The vested interests are too high. Just as in New Jersey, you have to have, when you get gas pumped in New Jersey, you have to have an attendant. God knows what gas station industry group requires that, but somehow that ain't never going to change. I think the same thing with securities and insurance regulation. So how do we get there? I don't know. I think I would like to see a very simple fiduciary duty rule at the federal level, and I think there should be tremendous pressure at the state levels to implement that, given the power of the financial industry in Congress and at the federal level and at state courthouse levels where a lot of the action takes place. I'm not sure it's ever going to happen, to be honest.
So, Ethan, as I sort of highlighted in preparation for this discussion, there are some fundamental ways in which certainly I see some of the same things you do, and I agree with a lot of the things that you say. I think that where I see a sort of a key difference is that I'm not yet convinced that this is purely an issue of either a regulatory agenda or or sort of an industry agenda. Those are real, for sure. If you're in the financial service industry, you want to make money, you want to earn margins, for sure. The regulators are trying, hopefully trying to protect consumers. Ultimately, though, I think that there's a behavioral element here that is that overwhelms a lot of these factors. And as I sort of suggested earlier, you can put very, very simple solutions in front of people. So you mentioned the TSP, which I think is a fantastic program. So I totally agree with you. It's an amazing It's an amazing, efficient program. But people want their hands held. People want to be shown things that are exciting and that feel different. And then the DIY alternative, and some of the things you've written about, you've actually sketched out, I thought, quite well. Sort of, here's how you would do this on your own and outperform paying somebody to do this. And I know very, very few people that would have the capacity to actually actually manage a portfolio like that themselves. You could, because you're an experienced portfolio manager. Arguably, I could. I have to say, it's one thing to do that in one's 50s, right? But when you're 70s or 80s and 90s, that's what you need to do. You need to actually manage this theoretical portfolio from now until you die. You've got cognitive decline. You've got all kinds of issues. So ultimately, you end up paying somebody. Right. And what I'll tell you is that the cost of a financial advisor is actually quite a bit larger than one might think, right? So it's a typical sort of a basic, minimum is sort of more like $2,500 or so, and then it's really driven by assets under management, which means that like people with a lot of assets, end up paying a lot proportion to the service that they're getting, and then people that have fewer assets, in theory are getting a better deal, but some of them may not get any coverage at all because 1% of a small number doesn't mean much. So, and then I guess this sort of gets to Paul's point, like there's a middle ground here that involves consumers either having to learn how to do this themselves, and I don't have confidence that all the consumers that we need to help can do that, and an industry that needs to make things, at least to make simpler alternatives available. So, I say all that to say is that I get frustrated when I find that people don't understand compound interest enough. By people I mean to the general consumers. I get equally frustrated when the industry is held to a benchmark that's completely frictionless, right? Right. And that assumes that an individual could actually manage with perfection over a lifetime, subject to all the behavioral things that people get into, that every human gets, even professionals, right? You have to say that, like when you worked in the industry, I'm sure you saw industry professionals making at times emotional decisions, and when it's your own money, it's even more the case. So I don't think we can ignore that element. That's the key point. Again, you and I agree on a lot of things, but that's one thing that I feel like we can't neglect, because I think that then I don't think it's a realistic benchmark often.
No, I don't disagree. I think you're absolutely right. I think you're making a lot of very powerful points. And of course, I'm sort of talking about the most obvious and in some cases abusive examples that are out there, right? So there's a lot of good in between, and I think the financial industry is producing a lot. Look, I think the financial industry is great. I think I'm a big fan of the moving towards indexing. I think robo investing has a lot, and not robo investing to me doesn't mean like you hit something on your keyboard and send a check. It means you work with an advisor to pick products that are designed to pay you out over a certain rate or rebalance you over a certain rate or all of that. So there's always a room for the hand holder and whatever. I think there's a middle ground. But I just think we should start with getting rid of some of the things that are really taking money out of people's pockets needlessly. And to be frank, I think are sometimes misleading, even if unintentionally so. But I don't disagree with a lot of what you say. We agree about a lot more than we disagree.
Yeah. So here's one thing that came out in a conversation you and I had previously that that I thought was interesting, and if you're willing to share it, please share it, and if not, we can edit it out.
Sure.
Sure. But there are annuities that you find interesting economic opportunities right now. Can you talk about that? Tell us about that, because like that's the whole point of the show is again different views. We want to. You've been very articulate about the things that you see as challenges. Tell us about some of the things that are working really well and you think would be a great growth opportunity.
Sure. Look, I think plain vanilla is MIGA the right term for them? I mean, plain vanilla annuities. Some of them are offering great rates, great risk-adjusted rates, meaning relative to the strength or weakness of their insurance company. They're beating treasuries. You're getting tax deferral, although I'm not sure that's really as valuable in the long run as it seems. But I invested a boatload in those. I think, depending on whether, I think those are great places to put some rainy day money for a year or 3 or 5. You're making more than you would be making from a treasury bond. If you invest in a good, solid insurance company, it's very safe. The money could be there when you need it, depending on the withdrawal terms, as long as those are transparent. And then look, and you got the bonus that when you get to retirement age, if you decide you want to annuitize that, and if the payment is simple and fair and easy to understand, great, annuitize it. Why not? But I do think that as you get increasingly down the complexity and expense end of things, you have to be a little more cautious. It's so simple. So yeah, that's a great thing. Look, also longevity annuities. I mean, to go back to your point about ROI, I agree with you that you can't just look at ROI. If you go onto a list of annuities, and you find annuities from companies with strong financial ratings, not right now in a low interest rate environment, but maybe a year or two ago, you could find some things where if your concern was, gosh darn it, you just wanted to make sure that if you live to 102, that your last death rattle, there would be a nickel in the cup to, buy a Coke or something. There were some things out there that, they were okay. And then you could lie back and forget it for the next 40 years. I mean, that's not the worst thing in the world, right? But you got to know what you're getting into. Somebody has to explain to you, you're not going to be protected against inflation. Or if you are protected against inflation, your ROI is going to be very low, right? What could you do in index funds that might give you that protection? So I got nothing against those.
Well, not only you have nothing against you invested in one category. Which
I did.
Allocated to MIGA. So
they should.
It's helpful to know. Thank you for your openness.
But no, I'm just what else? There was something I was going to. You may want to cut this out. I'm mumbling to myself. There was a major insurance company that has some stuff that I don't like so much. Bought a smaller insurance company that has some stuff that I do like quite a lot. I wish I had remembered the name to, at least give my positive opinion. But whatever.
Yeah.
You can cut that out.
Yeah. So Ethan, I think you make a lot of very interesting, good points, right? I think it's and we've hit on a lot of the complexities. I personally am an optimist that I think a lot of the advances we've seen, fintech. Cheaper administrative platforms, moving to cloud. Eventually, the structural machinery, right, that dictates, especially on the insurance side, what minimum deposits are, what size of policy have to be, that should shrink. And I think that's going to open up the opportunity for a lot of products that target the masses who, as Ramsey said, can't afford the financial advisor. If you were, we have a new administration. Ethan, if you found yourself as head of the Consumer Protection Board, what would your what 2 or 3 things would you put on the agenda to make sure that the people who aren't being served right now would get the kind of financial and retirement advice that Ramsey talked about?
Well, first of all, unfortunately, I think the CFPB specifically can't do anything about anything related to an insurance company, right? Because wasn't it the Harkin Amendment? Is that what I'm thinking of? That Senator Harkin. Right. So I don't know. That's where I'd want to be. So maybe you have to change that first. Look, I know there could be a lot of disagreement about this. I think a simple fiduciary duty rule that covers everything, that anybody who gives financial advice should give the best advice. And I know that's rife with problems because, you don't make somebody who's selling Chevys say, well, gee, the Ford might be a little bit better for you. But I think There has to be some way to craft something that at least obliges financial advisors of any shape and size and stripe, and whether they're selling mutual funds or insurance products or whatever, to at least show people the basics, right, and have an obligation to do that. Right? So that's one thing that I think I would go a long way. Second of all, I think the entire 401k and retirement structure should be rethought. I think there were reasons for it to be structured the way it is maybe 30, 40 years ago, when there really were no readily affordable sources of financial products. I think now, I went out to dinner at the Cheesecake Factory last night, right? Good food. Am I allowed to plug the Cheesecake Factory? I like the Cheesecake Factory, right? Very sophisticated food. You can get Thai food. You can get Southern barbecue. Guess what? Right next door is a Fidelity, and down the block there's a Charles Schwab, and there's life insurers up and down the street. There's tons of stuff out there that wasn't available 40 years ago. You don't need to go through your employer's 401k plan, right? That's a needless expense on your employer. And it's just another bunch of intermediaries, with their hands out taking money from your wallet, right? So that's another thing. I would completely rethink that. There is, I think, Ramsey, you made some brilliant points about behavioral biases. Human beings do want, somebody to hold their hand. They want things that are exciting. Whether it's enough to just, strip everything down to a fiduciary duty rule, a disclosure rule, I don't know. Maybe that's not the way human beings work. But, I think those would be good starts. So.
All right. Well, hey, listen, thank you so much. We're right at the top of the hour. I guess, Will, Mark, Ramsey, any parting thoughts or questions?
No, Ethan, really appreciate your perspectives.
Cool. It was fun.
It's a unique perspective to have on the show, so it's good. I think we value all opinions and inputs, and yours was definitely worthwhile and interesting to hear.
Great, thank you. I really enjoyed talking to you guys. You're very good at what you do, and you know a lot of stuff. I learned from speaking to you.
Yeah, and I think, Ethan, to your point, there's a lot that goes into the definition of value to an individual, other than cost, right? So I can go in the other room and make a cup of coffee for 25 cents.
Absolutely.
There's a line of people down the street waiting to pay $5 for a cup of coffee.
That's a great analogy.
There's a value proposition there. I do know that the number one concern that we hear among retirees is running out of money. And there's a lot of products out there that can really mitigate that concern and risk. So I think the value behind that, it can really be priceless. So I think there's a lot of different ways to look at it. And I think that, your perspectives are very interesting. So thank you.
Thank you. No, I really enjoyed speaking with you guys.
So I'll just say, first of all, thanks, Ethan, for joining us and your candor on all fronts. I'm of the belief that none of this can happen without technology. All the things that we collectively want, I think, will require technology to deliver and to deliver at scale. And ultimately, this ends up being a technology problem and in many ways a marketing problem. Whatever we're trying to do, whether we're trying to make everything low cost index funds or whether we're trying to go whatever the case is, I think that it is difficult for any individual, even just say a fiduciary advisor, they tend to sort of focus on stocks and bonds for the most part. So there's implicit biases there, right? And even there, are they focusing on the best stocks and bonds? I don't see how any individual can really perform a best interest function in the long run, right? Without technology to be able to sort of provide those comparison points. So, I mean, that's what Paul and I are trying to do every day. And
it's a worthy,
long way to go.
Worthy effort.
Yeah. Hey, well, listen, thanks so much, Ethan. Thanks all to our listeners. Make sure to give us feedback and share the show with your friends. Appreciate the feedback. And Ethan, thank you very much. Will, Mark, Ramsey, enjoyed the show.
Take care, guys.
Thank you.
Thank you.
Thanks.
Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.